Hello everyone, and welcome back to Gold Rush Reporter. Before we dive in, make sure you hit that like button and subscribe. This is where we cut through the noise and bring you the truth the mainstream won't touch. Today, we're looking at one of the most consequential financial shifts happening right now, and if you don't understand this, you're missing the biggest story in global markets. For decades, the Japanese yen carry trade has quietly been the engine fueling trillions of dollars flowing into US treasuries, stocks, emerging markets, crypto, you name it. Investors borrowed yen at virtually zero interest, converted it into dollars, and poured it into higher yielding assets. Every dividend, every capital gain, every bit of interest was essentially pure profit, because the loan cost nothing. But the era of zero interest rates in Japan is over. Even a slight increase in rates has massive implications. Suddenly, those trades that seemed risk-free are becoming dangerous. Japanese pension funds alone hold over $1.1 trillion in US treasuries. Globally, the carry trade represents trillions more. And now, the yen is strengthening, making unwinding these trades increasingly costly. What does this mean? It means we could be witnessing a systemic ripple that impacts every corner of the market, from bonds to equities, from crypto to commodities. When Japan starts liquidating its treasury holdings to cover positions, US yields rise, and the stronger yen compounds the problem. This isn't a minor correction. It's a domino effect that threatens to shake markets on a scale most people don't comprehend. Investors have been lulled into complacency, relying on mainstream advisors who ignore the underlying distortion. The textbooks they studied didn't prepare them for a world where global leverage and currency trades dictate market stability. Meanwhile, gold and silver are quietly responding to these structural shifts. Unlike paper markets, they aren't manipulated by liquidity injections or foreign bond sales. They respond to trust, or the lack thereof. So, as we head toward the next Bank of Japan meeting in December, this story is only going to intensify. Interest rate changes may seem small, but in a market built on decades of zero-cost borrowing, they are seismic. Understanding this is critical, because it explains why gold and silver are not just rising. They're defying every traditional expectation. Stay tuned, because in this series, we'll break down exactly how this unwinding works, what it means for your investments, and why owning physical metals is no longer optional. It's essential. Now, let's break down the mechanics of what's happening. The Japanese yen carry trade isn't a small ripple. It's been the single largest arbitrage in financial history. Trillions flowed into US treasuries, S&P 500 stocks, emerging markets, crypto, and leveraged instruments. Hedge funds, pensions, and global funds built entire strategies around it. And suddenly, that conveyor belt is jamming. Japan raising rates, even slightly, changes the cost of borrowing yen. Assets purchased cheaply are suddenly at risk because the currency needed to unwind those positions has strengthened. This is why US interest rates are acting strangely. Powell may cut, the Fed may talk about inflation and employment, but the long end of the Treasury market refuses to move. The market isn't domestic anymore. It's global. One of the largest buyers of US debt is now becoming a seller. When Japan liquidates its holdings, yields rise, not because the Fed wants them to, but because supply overwhelms demand. And as yields rise, borrowing costs climb, leverage unwinds, and forced selling accelerates. It's systemic. This is also why precious metals are surging. Gold and silver aren't moving in lockstep with yields or the dollar. They're reacting to trust. Trust in the system, trust in fiat, trust in promises that can no longer be honored. Silver, in particular, is extremely tight in supply. Industrial demand is rising, solar and semiconductor industries are absorbing more, and monetary demand is kicking in. There simply isn't enough above-ground silver to meet simultaneous industrial, investor, and sovereign demand. That's why the market is reacting violently, not gradually. And while mainstream analysts scratch their heads over rising gold and silver, they're missing the structural story. They look at yields, CPI, inflation, and dollar strength. But those are second-order effects. The first-order effect is confidence, or the erosion of it. When global investors realize that decades of zero-cost leverage are evaporating, they don't rotate into stocks. They rotate into assets outside the system. That's exactly what gold and silver are providing. This isn't a trading pattern. It's a repricing event. Just like the 1970s, when silver spent years consolidating at $2 an ounce before spiking to $50, we're seeing early stages of a similar transformation. The yen carry trade unwinding, combined with structural tightness in precious metals, is creating a scenario where old rules no longer apply. And this is just the beginning. Now, let's look at the global picture. Japan isn't acting in isolation. China, the UAE, and other BRIC nations are quietly creating parallel systems to bypass the dollar entirely. Enbridge, the cross-border payment system, allows settlements in gold without involving Western banks. Transactions that used to take days and incurred massive fees now settle in seconds with minimal cost. This shift isn't just about convenience. It's about sovereignty and monetary independence. Countries are preparing for a world where reliance on the dollar is no longer safe, and gold becomes the ultimate settlement tool. Meanwhile, US markets feel the pressure. The yen carry trade unwinding is creating forced selling in treasuries, equities, and leveraged positions. Investors accustomed to easy returns are suddenly facing losses. Volatility spikes. Traditional correlations between gold, stocks, and bonds break down. Gold and silver aren't falling with the market. They're rising. That's because they aren't commodities in this scenario. They're monetary insurance. When confidence in fiat erodes, demand for physical metals explodes. Look at silver specifically. Its supply is far tighter than gold. Industrial demand, solar, semiconductors, batteries, is skyrocketing. At the same time, monetary demand from sovereigns and investors adds upward pressure. The market can't meet all these demands simultaneously. That's why silver's price action is parabolic rather than incremental. It mirrors the early 1970s, years of consolidation followed by a rapid repricing that makes previous highs look trivial. This is not a trade setup, it's structural. For investors, this is a moment to pay attention. The conventional advice of diversify into equities or bonds no longer applies in the same way. Fiat assets are exposed to systemic risk, global leverage is unwinding, and central banks are not aligned. Each major central bank has its own priorities. The Fed wants to cut, the ECB wants stability, the BOJ must defend its currency, and China is building parallel systems. In this fractured environment, precious metals are not just a hedge. They are the only asset class outside centralized control, outside systemic vulnerability. This is why mainstream financial commentary can't explain the current movements. Analysts are still trying to use old models: dollar strength, inflation rates, treasury yields. But the market is being driven by the collapse of confidence, the unwinding of decades-long leverage, and structural scarcity in precious metals. Understanding this is crucial, because what you see in everyday headlines barely scratches the surface of what's driving gold and silver today. As we move closer to the year end, all eyes are on Japan's next policy moves. Even a tiny rate hike triggers a shockwave across markets. Remember, the yen carry trade was enormous, trillions of dollars globally. When Japan finally lets go of the peg that kept this trade artificially alive, forced liquidations will cascade through treasuries, stocks, emerging markets, and even crypto. This isn't hypothetical. It's happening in real time. Meanwhile, gold and silver continue to behave in ways that defy traditional Wall Street logic. The dollar can rise, bond yields can rise, but gold still surges. Silver breaks historic resistance levels. This is the market telling us something fundamental. Trust in fiat is eroding, and tangible monetary assets are becoming irreplaceable. Unlike leveraged paper markets, metals are scarce, portable, and outside the direct control of central banks. The supply-demand dynamics are accelerating, a repricing that the mainstream can't yet comprehend. Industrial demand compounds the story. Silver usage in solar panels, electronics, and batteries is exploding. Combined with sovereign accumulation and investor demand, the physical market is under extreme pressure. This creates a scenario where metals aren't just appreciating, they're being recognized as monetary assets again. History shows that when scarcity meets structural demand, prices can move in parabolic fashion. Silver isn't trading, it's being revalued. Investors need to understand the disconnect between perception and reality. While traditional advisors focus on CPI, tech stocks, or short-term trends, the macro picture tells a different story. Global leverage is unwinding, confidence in fiat is collapsing, and central banks are acting independently with conflicting priorities. In this environment, owning precious metals is not speculation. It's a defensive strategy against systemic instability. Finally, this isn't just about wealth preservation. It's about positioning for the structural shift underway in global finance. Nations are bypassing dollar systems, building parallel settlements, and emphasizing gold-backed infrastructure. The yen carry trade may be unraveling, but the forces reshaping global capital flows are only accelerating. For anyone paying attention, the lesson is clear. Metals are no longer optional. They are essential. As we close out this update, the key takeaway is simple. The global financial system is under enormous pressure. The unwinding of the Japanese yen carry trade, rising bond yields, shifting central bank policies, and the growing importance of gold and silver are converging. What was once a predictable system is now volatile and unpredictable. Investors who understand this are the ones who will protect their wealth and potentially profit from the shakeout. Gold and silver are no longer just commodities, they are monetary assets. Physical scarcity, industrial demand, and sovereign accumulation are driving a structural repricing. The mainstream doesn't understand it yet, but the signals are clear for those willing to look beyond the headlines and the daily noise of conventional markets. This is why staying informed is crucial. At Gold Rush Reporter, we track these developments closely, delivering insights that help you see the bigger picture and make decisions based on facts, not fear or hype. Knowledge is the first step to safeguarding your wealth in uncertain times. If you want to stay ahead of the curve, make sure to subscribe, hit the like button, and turn on notifications. We bring you timely updates, market analysis, and exclusive insights on gold, silver, and global finance. Visit our website and join the newsletter to get direct alerts on price movements and key developments shaping the precious metals markets. Thank you for watching Gold Rush Reporter. Stay vigilant, stay informed, and always think like a contrarian investor. The world is changing fast, and understanding the forces behind the markets is the only way to keep your wealth safe.